Okay, let's unpack this. Welcome back to the deep dive. If you're looking for a comprehensive read on, well, the state of high finance, today's sources really deliver. We've got four simultaneous high-stakes narratives. They really define the current pressure points in capital markets.
Yeah, we have threads covering some critical areas. There's a major corporate governance and legal crisis, shifting bond market liquidity dynamics, a strategic pivot in M&A,
Right.
and an unprecedented global legal standoff. We're zooming in on what connects these seemingly separate events.
Our mission is to move swiftly through this, stack lawsuits, spreads, M&A strategy, international standoffs, to really deliver those crucial knowledge nuggets. We're looking for the implications, not just the headlines. Let's start with the saga that has really defined investor protection debates recently. FIDU.
Right. The controversy surrounding the FIDU pop-up listing, well, it's just expanded its scope dramatically. Yeah. It's no longer just about the initial public offering.
That's the key development then, isn't it? We knew the initial IPO investors were suing based on allegations of false statements in the registration document, the Gaudiet Ossoff.
Exactly.
But now the victim group has broadened.
Precisely. The lawsuit now includes a second, much larger pool. We're talking about investors who bought shares after the August 2023 listing.
Okay.
Right up until that catastrophic November 8th revenue report.
Yeah.
This creates a critical legal distinction.
Help us clarify that distinction because it determines liability, right?
Yeah.
What's the second group of investors claiming?
So the initial IPO investors, they're relying on liabilities specific to the registration document itself.
Got it.
The second group, the talker or aftermarket investors, well, they have to rely on a broader claim. Compensation for unfair trading practices or,
That sounds like an enormous evidentiary hurdle. I mean, how do you prove that an aftermarket buyer relied directly on a document created months before for the IPO?
It is a massive hurdle. The central battle is defining the scope of the victim group, the Jinriego.
Right.
And just consider the sheer volume here. Sources indicate there were approximately 600,000 transactions during that short relevant period.
600,000, wow.
Yeah. So determining who bought, when, and whether their loss can be legally tied back to that misleading registration statement. It's extremely complex.
But the lawyers for those aftermarket buyers, they must be making a strong case.
They're making a powerful case. They argue that because the registration statement was the only public document providing fundamental performance data at the time,
Okay.
all subsequent buyers, well, they necessarily relied on its truthfulness. They're arguing their situation is legally identical to the IPO investors.
So extending that misrepresentation liability beyond the immediate offering date.
Exactly. And that matters deeply. If they succeed, this case fundamentally redefines liability for companies using the technology-based special listing route, the GENO.
It's a vital warning shot about transparency then.
Absolutely. And we should note, while FIDU stock has seen a bit of a recent uptick on general semiconductor optimism, it's still well below its 31,000 KRW initial public offering price.
A clear signal of that lingering corporate governance risk. Okay, let's shift gears entirely. Let's look at liquidity. The bond market is, well, it's presenting a fascinating paradox, isn't it? Corporate credit tightening against sovereign debt.
Yeah, this is a crucial indicator. It shows that the perception of risk in high-grade corporate debt is rapidly improving relative to government risk.
So the credit spread, the gap between the two, it's narrowed.
Significantly. It's narrowed to a 4-year low.
Give us the hard numbers. How dramatic is this narrowing?
Okay, the difference between the 3-year BOA corporate bond and the 3-year government bond, that's UNO, it's down to just 39 basis points.
39 BP.
Wow, that's tiny.
It is, especially when you compare it to the 178 BP spread we saw during that extreme liquidity crunch, after the 2022 Legoland incident, less than a third. So why? Why are these two massive asset classes moving in opposite directions? Corporates looking good, sovereign debt looking weaker.
It's a pretty clear supply-demand dynamic, and it's driven by policy. Government bond prices are weak, meaning higher yields because of the government's expansionary fiscal policy.
That huge 728 trillion KRW super budget.
Exactly. The market anticipates high future debt issuance to fund that budget. That increases supply and naturally pushes prices down.
Right. Increased supply means investors demand a higher yield to take it on.
Precisely. And conversely, the strength in corporate bonds that are lower yield, that's purely demand-driven.
Okay.
Investors are betting heavily on future interest rate cuts, both from the Fed and the Bank of Korea.
So they're buying now.
They're rushing to buy corporate debt now to lock in those higher rates before the inevitable cuts happen. And that creates immense buying pressure, pushing prices up and yields down.
That explains the short-term demand picture. But your sources suggest there's something deeper, a structural factor that could sustain this tight spread for years.
Yes, and that takes us to the really strategic element here. The long-term driver is the expansion of large domestic securities firms getting permits for issuing,
Promissory notes.
right, promissory notes, and also IMA businesses.
Okay, we need to define IMA fully. What's the impact of those integrated money account businesses?
Well, an integrated money account and the promissory note business, too, basically allows these big securities firms to act almost like banks.
Oh, okay.
It massively increases their assets under management, their AUM, and their ability to purchase longer-term, higher-yielding assets, like corporate bonds.
I see.
Estimates suggest that if all the major applicants get these permits, their collective AUM could swell by something like 185 trillion KRW by 2028.
185 trillion KRW. That implies a fundamental sort of permanent shift in the demand structure, doesn't it?
It really does.
Does that mean even bonds lower down the rating scale might see better liquidity?
It does seem that way. This influx of permanent long-term capital will likely sustain the tightening spread and boost overall liquidity. Researchers are predicting this demand will inevitably expand even to lower-rated A-grade company bonds.
Interesting.
It suggests a maturing capital market, where credit is more readily available outside of just the very top-tier corporations.
Okay, so from liquidity dynamics, let's transition to strategic capital deployment. We have some compelling insights from Samjong KPMG on where M&A capital is actually, well, moving.
Yeah, we've definitely seen a distinct sectoral rotation in M&A activity over the last year or so.
We hear about previously hot sectors, things like cosmetics, power equipment. They seem to be stalling out. Why the sudden cold shoulder?
It's largely down to what they call the valuation gap, the Halombocha.
Okay.
Sellers were demanding pretty aggressive premiums based on previous high-growth cycles. And today's buyers, they're much more sober, more strategic. They're just refusing to meet those inflated prices.
But waiting for things to rationalize.
Pretty much. Waiting for market values to come back down to earth.
So if traditional sectors are stalled by this pricing standoff, where are the buyers focusing their growth bets now?
The consensus really points toward IT and AI sectors. That seems to be the new growth axis.
Examples.
Well, look at EQT Partners' acquisition of Remember and their continued push for Do Zombizon. Or the significant investment in T-Max Group by Estic and Cactus PE.
Right.
Private equity, which, historically kind of shied away from complex enterprise IT, now sees undeniable potential and real quality in these emerging tech companies.
But let's look at the twist in strategy here. Our source highlights something fascinating. Global private equity funds, the big PEFs, they're now lowering their sights dramatically.
This is a major shift. You've got global behemoths like Blackstone, who typically chase those multi-billion-dollar deals, now actively competing in the mid-market segment. They're targeting deals in the, say, 300 to 500 billion KRW range.
Why would these global titans divert resources to mid-size acquisitions? Seems counterintuitive.
Well, they need to deploy their dry powder, all that unspent committed capital they're sitting on.
Oh, okay. Makes sense.
In mid-market deals, they offer faster investment cycles, easier entry points, and crucially, quicker exits and returns compared to those slow, massive corporate carve-outs.
So it's efficiency.
Efficiency and speed. But this maneuver is driving up competition significantly. It puts global PEFs in direct competition with domestic funds in a segment that was, previously dominated by local players.
It really signals the maturity and the global attractiveness of the Korean mid-cap space then.
Absolutely.
Okay, that sets the stage nicely for our final and very high-stakes battle.
You can't bet.
Brookfield IFC dispute. The drama here is just unprecedented.
Yeah.
Brookfield's ongoing refusal to return that 200 billion KRW contract deposit to Mirae Asset.
Yeah.
Despite having lost the definitive arbitration case.
And the ruling by the SIX, the Singapore International Arbitration Center, it was completely unequivocal.
It was still clear.
Crystal clear. They required Brookfield to return the 200 billion KRW deposit, plus interest, plus costs. They ruled Mirae Asset was not responsible for the 2022 contract termination. Full stop.
But international arbitration is designed to be binding and final, isn't it? What justification can a global giant like Brookfield possibly have for ignoring a clear ruling from a major body like SIAC?
Well, this is what makes the action so disruptive, so unusual. International commercial arbitration, particularly under SIAC rules, it functions as a single instance decision, a ME,
Meaning?
meaning there is typically no general appeal process. The grounds for annulment in the Singaporean courts are extremely narrow, often limited only to issues of procedure, not the actual merits of the case.
So Brookfield is essentially challenging the finality of the entire international dispute resolution system itself.
That's pretty much what it looks like. Precisely. They're invoking a maximum 3-month period to review the judgment and consider applying for annulment.
Delay tactics.
It seems that way. Their APAC HQ, their North American HQ, they're directly involved now, mobilizing global law firms, exploring every single legal corner.
But for a firm managing roughly $1 trillion globally,
Yeah.
their decision to persist in non-compliance, despite a clear ruling, it must risk substantial damage to their global reputation, their reliability as a counterparty.
You'd think so. That's the core question, isn't it? Why risk your reputation, your credibility for a 200 billion KRW deposit, which is, frankly, not enormous for them?
It suggests they're willing to test the enforcement limits of international law itself.
Indeed, it signals a potential shift. A willingness perhaps by some global funds to use every procedural lever available, even delaying tactics to fight a judicial defeat in these high-value cross-border transactions.
Yeah.
Even if it strains the perceived finality of the international system we rely on.
Okay, so we've synthesized 4 crucial insights today. We saw increased legal scrutiny defining corporate liability in the FADU case, powerful demand, and structural changes tightening corporate bond spreads.
Right.
Strategic capital, prioritizing IT and AI, while global PES dive into the mid-market.
Yep.
And finally, this rare spectacle of a massive global fund testing the very enforceability of international arbitration in the IFC dispute.
Yeah, these sources really reveal a market that's constantly balancing perceived risk, don't they? We see legal uncertainty creating new liabilities, demand-side forces smoothing liquidity risk, strategic pivots managing growth risk,
Reputation.
and profoundly, yes, reputational risk being weighed against financial loss in the global arena. It's fascinating.
So here's something for you to mull over. If a global investment powerhouse like Brookfield is willing to push the boundaries of established international arbitration just to avoid paying a deposit, what does that fundamentally tell you about the future stability and, maybe more importantly, the quick enforcement of high-value judgments in cross-border finance? It's a real challenge to the global rulebook we thought we knew, isn't it? Something to think about.